award-winning research.
Thank you so much, Dean Taylor, for the kind remarks. I too would like to thank Dick Mahoney for this award. We are an applied field, so the true value of our research isn't realized until it makes its way into practice. And students, of course, are one vehicle for making its way into practice, but I'm sorry, I'm trying to do the slide. I'm trying to share my slides at the same time. Play from the start, there we go. Students are one vehicle for doing that, but the most important vehicle for that is business leaders such as yourself, because students take a while before they can put things into practice. So I'm very grateful for your being here, and I'm grateful to Dick Mahoney for sponsoring this award and giving me this opportunity to meet with you. So I wanted to start this morning by offering some wisdom from Father Guido Sarducci. He was interviewed by Jane Curtin a number of years ago on Saturday Night Live's Weekly Update. This was at the time that they were considering Mother Teresa for sainthood, and she asked Father Sarducci what he thought about that, and he said he didn't think it was a very good idea. And she said, well, why not? He's had, she performed 3 miracles, and he said, well, 2 of those, they were card tricks. So the reason I'm sharing this with you is that I did get an award for what seems to be a very similar paper not too long ago. So you may think that this award was a card trick, and I'm hoping to convince you otherwise. So these 2 papers do share the RQ measure, and they also share an interest in fixing the broken innovation engine. So let me just share with you what I have in mind when I talk about the innovation engine being broken. So historically, innovation has been the primary driver of growth. It accounts for about 67% of growth. The other 3 things that we think about, capital growth, labor growth, and improvement in the quality of labor through education, together only account for about half that, so 37%. So let me show you how it's played out historically. This is companies' R&D spending. This is R&D divided by their revenue, so their R&D intensity. And what I'm showing you next is GDP growth. So you can see that GDP growth tracks R&D spending with a lag. It tracks it through the rise, it tracks it through the fall, but it never picks back up again in the 80s when R&D spending picks back up. In fact, it continues to decline, and it's declining even till today. So the broken engine is clearly not a spending problem. What it is, in fact, is a productivity problem. And to help you understand that, what I'm going to do is show you again the GDP growth curve. And now what I'm going to plot on that is companies' R&D productivity using the RQ measure. Or I think I am. There we go. All right. So as I said, the 2 papers share the interest in solving this problem. But what the first paper did was look at a specific thing that companies were doing differently that might have contributed to the decline. And today's paper is more fundamental. It's looking at why companies would have changed their behavior in the first place. And I believe that's because they're flying blind with respect to R&D, because they lack good measures of R&D productivity, or R&D period. So to help us, to help see where we stand with respect to this, what I'd like you to do is help me out. Let me know what measure you most use to gauge company innovation. So if you're inside an R&D firm, tell me what measure you and the company use. If you're an investor and you invest in companies who conduct R&D, then let me know what measure you use to gauge their capability. The format for this is, so first of all, let me step back. I believe in the text, you have this link. And if you cut and paste that into your phone, then you can access the poll. So let me just give you a few seconds to do that. And while you're doing that, what I want to do is explain how this particular format works. So what you can do is a free text response for whatever measure you use. After a number of measures have been proposed, then you can vote up or down if you've already seen a measure that you most use. Oh, good, thank you. I was wondering if it was working, and now I've got confirmation. We've got an extra vote for ROI. And I should say that this research started while I was at Hughes, precisely because we were asked to provide the ROI. And we can talk about that offline, but it's not part of the presentation today. All right, I think you can continue to vote. But what I'm going to do is I'm going to keep in mind what your response is, and then compare these to some work that was done by the Industrial Research Institute. So this was an organization of company R&D managers. They surveyed their members and found that that R&D metrics was one of the chief problems that they faced. And they said that the problem wasn't that there were lack of measures. In fact, there were 250 R&D metrics. And the fact that there is 250 metrics is evidence, I think, of the problem, because nobody's completely satisfied with the measures that they're using. The things that the IRI identified is that the data are difficult to collect. They aren't uniform across business units. They can be gamed to make a given group look good. They focus on inputs or outputs rather than the conversion of inputs to outputs. ROI, of course, is an exception to that. And they felt that the most important thing was that the measures weren't meaningful to shareholders. So lack of measures has two implications. There's a front-end implication and a back-end implication. The front-end implication is that firms aren't sure how much they should be spending on R&D. And to illustrate that, what I've plotted here on the x-axis is optimal R&D. And what I mean by that is the level of R&D beyond which the next dollar of R&D will generate less than $1 of profits. And what I have on the y-axis is what firms have actually spent on R&D. So each dot is comparing companies' optimal to their actual. And if they're investing optimally, they will be along that red line. And what you can see is that less than 5% of firms are actually within plus or minus 10% of that line. Most people think the problem is for firms are underspending on R&D, but in fact, the opposite is true. 63% of firms are overinvesting in R&D, and on average, they're losing $258 million in profits each year. There are, of course, firms who are underinvesting, those below the red line, 33% of firms, and if they were to increase their R&D by 10%, they would have 36 million higher profits. So that's the front end implication. The back end implication is that companies aren't sure whether their R&D is effective. So if they introduce a new policy, they have no way of knowing whether that policy was effective or not. And that's what I had showed you previously for the productivity decline chart. So let's put these two things together with a real world example. This is becoming a little bit dated. It's from 2010, but it's from a column in the New York Times, Joan O'Sara's column, and it looks at the ousting of Mark Hurd as CEO of HP. And he interviewed Charles House, who was a longtime engineering manager at HP. And Charles House rejoiced that Mr. Hurd was leaving. He said, "I think the sexual harassment charge was a total red herring. Mr. Hurd was systematically destroying what had always made HP great. As an example, the R&D budget used to be 9% of revenue, and now it's only 2% of revenue." So the question is Mr. House right? Did Mark Hurd destroy what made HP great? The problem with existing measures is we have no way of knowing whether R&D capability has deteriorated, or if so, by how much, or whether the correct investment is 9%, maybe it even is 2%. Academics aren't helpful in this regard. The primary measure that academics use in testing innovation is patents. Over the past 2 decades, there have been about 250,000 articles in business journals using patents. And the problem with patents is only 50% of companies that do R&D file patents at all. The rest of them protect their innovations through other means, principally through trade secrets. The other problem with patents is that they're apples and oranges. So 10% of patents account for 80% of the economic value of patents. So what we want to do in this paper is ask the question, are academics flying blind as well? And in that flying blind, are they therefore contributing to the decline in companies' R&D productivity? I should say that this is joint work with finance colleagues because I'm a strategy professor. Because I'm a strategy professor. Mike Cooper and his former PhD student, Wenhao Yang. What this paper does, let me say what this paper does before I go to the next slide. So what we're doing is we're going to run a horse race between RQ and the existing innovation measures. So before getting to the horse race, let's think a little bit about what an ideal measure should look like. First, it should satisfy some fundamental criteria. You want it to be reliable. You want it to match the theoretical construct that it's trying to capture. And so far as it does, and it should be able to predict outcomes. You want it to be universal. You want to be able for it to be used by all companies who innovate. So anyone who does R&D, you'd like it to be uniform. So it has the same meaning across companies, across industries, and across countries. And you want it to satisfy the practical criteria that IRI identified. And I, of course, believe that, well, I don't just believe, it is true that RQ satisfies the measures that it's universal, uniform, and it has the practical criteria by its inherent nature. One of the frustrations I think firms have with it is that it can't be gamed at all, and that's a frustration if you're going to be measured by it. So basically, what we're going to be doing in this paper is testing the reliability criterion. Okay, so let me just remind you what RQ is. What's nice about Dean Taylor gave you a nice review of it. It's short for research quotient. I like to think of it as the company equivalent of individual IQ. It's how smart companies are. Just as high IQ individuals solve more more problems per minute, high RQ companies solve more technical problems per dollar of R&D. But that's the intuition. What's really nice about RQ is that it's rooted in theory. And in particular, it's rooted in Paul Romer's theory linking R&D to growth at the economy level. He won the Nobel Prize for that theory in December 2018. So let me remind you what that theory looks like. The heart of it is the production function that you may remember from managerial economics. What the production function does is it links companies' inputs to their outputs. The ones that we typically look at are capital and labor. Those are on each of the axes. And then what we have is we have a series of concentric curves which represent levels of output. So you can think of the inner curve as 100 widgets, 200 widgets, 300 widgets. And what the tool does is it helps you decide whether you should be at point B, spending a lot on capital and very little on labor, or point D, roughly equal amounts of each, or where, in fact, anywhere along this continuum is optimal. So Romer's insight is to say, hey, there's a missing input, knowledge, in this production function, and the role of knowledge is to make companies more productive with any given level of capital and labor. So pay attention to point C here, where you are producing 200 widgets. When you add knowledge, what happens is you are producing 250 widgets with the same level of capital and labor. Where does knowledge come from? Not surprisingly, it comes from R&D. And in particular, the amount of new knowledge you'll get from R&D is a function of how much you're spending, R, how much knowledge you had to begin with. So the idea here is that you can't do calculus until you've had algebra. And the term delta, which is the productivity in converting R&D to new knowledge. The most important conclusions from Romer's theory are that the economy will grow in perpetuity so long as you continue to invest in R&D. And in particular, the rate of growth will be proportional to the level of R&D. So if you double the R&D spending, you should double the growth rate. Now, Romer's theory is at the level of the economy, but the production function's inherently a firm level construct. So everything he's predicting at the economy level should hold at the firm level, and RQ exploits that. So it's trying to capture delta at the company level. So how do we do that? Let me remind you Romer's equation when he adds the knowledge to it. Now what we do is we substitute knowledge with the R&D that produces it, and we give R&D an exponent just as capital and labor do, and we call that exponent gamma. So RQ is exactly gamma, and I argue that it should be a good proxy for delta in Romer's theory, and of course the horse race is going to be testing that. So RQ has a technical definition. This is what Dean Taylor shared with you. It's the firm-specific output elasticity of R&D. That's meaningful to all of you because you've had managerial economics. But for everyone else, what's nice is that it's got a practical translation. It's the percentage increase in revenue you expect to get from a 1% increase in R&D. Now, here's what's really nice about being derived from theory, that the measure will support prediction. So revenues is straightforward. RQ is estimated from the production function. So if you want to know how much revenues will increase from a given level of R&D, you just plug it into this production function equation. Profits are just gross margin times those revenues, subtracting off the R&D. Optimal R&D is the partial of profits with respect to R&D. It looks like a mess, but you can spreadsheet it. And market value is just the net present value of profits. So what we are going to do in this paper is we're going to test the link between RQ and market value, because the market value relationship stems from all of these with the exception of optimal R&D. All right, so we basically just have two charts on the paper itself, but here's the two charts. So this is our horse race, the innovation measure horse race. We're going to look at three different measures of market value. We're going to look at current market to book, future market to book, and excess monthly stock returns. We're going to look at 6 innovation measures, RQ, which I just shared with you. We're going to look at patent counts and citation counts. Citations are when a patent that's granted after yours cites your patent. That's an effort. The use of citations is an effort to control for the apples and oranges problem. So patents that are more valuable should have more citations. There are 2 versions of that. There's an additional version of those 2 measures. They're called innovative efficiency, patents and citations. And basically what that does is it just takes 5 years worth of patents and divides it by 5 years worth of R&D. And then there's a final measure that one of the reviewers asked us to include. We'll use standard controls in all our regressions, and I've shown those here, but I'm not going to spend any time with those. I will spend a second talking about 2 samples. So for all of our tests, we're going to look at, as it says, 2 samples. And the reason this is important is that I learned in this exercise that the standard treatment, when you take a database of all companies that do R&D, is to set their, if they don't have patents, then you set that equal to 0. On the face, that makes perfect sense. They don't have patents. But the problem when you're using patents as the measure of innovation is that you're inherently saying those firms have no innovation. And that is not plausible. Otherwise, these firms wouldn't be doing R&D. So we also construct a separate sample where we get rid of all those firms that have no patents. And we think that's more realistic. So here's the Tote Board, the results from this horse race. What I have on the left-hand side is that first panel of firms, so where patents are set equal to 0. What I have on the right-hand side is where we drop firms that have no patents. And each row represents one of the patent measures. Now I've color-coded this so that you know, rather than showing you the numbers, because I wanted them to pop out. So a green represents a positive and statistically significant correlation with that measure in that regression in that sample. And so what you can see right off the bat is that RQ is robust to all of the samples, to all of them. It robustly predicts market value regardless of which measure we use. And it does so when we include each of the innovation measures in the same regression. You can see that patents and the innovative efficiency measure, so patents divided by R&D and citations divided by R&D, seem to do pretty well, except in the regressions where we're looking at excess stock returns. Then if we look at what I think is the realistic set of firms, there's no correlation between excess stock returns and the patent and patent citation efficiency measures. One thing that you notice between the left-hand side and the right-hand side is that that's true when we are excluding patents, not true when we include firms without patents and give them a 0. So what this is suggesting is that past research using this measure was deriving its results by just comparing firms who have no patents to firms who don't have patents. Something you should be worried about is just using patent counts leads to negative correlations with market value, and citations has varying results depending on which specification that you actually use. All right, so why do we care? This is just seems to be academic. Why we care is because I've shown you, well, before I say that, let me say why they have different results. So they're measuring different things. Okay, so you can think of R&D as the input or the seeds. You can think of patents or the innovation as being seedlings. So it's an intermediate output. It's not the output you care about. What you care about is you care about crops that you can actually take to the market. And that's what RQ is capturing. In order to have a high RQ, you both have to be good at generating innovations and at commercializing those. And I should say that RQ and patents are only loosely correlated. So they're correlated at only about 8%, which is kind of evidence they're measuring different things. All right, now let me get to what I thought my next slide was going to be. Nope, not yet. Remember, 50% of firms bypass patents. They don't have patents at all, but they still do have seedlings. Okay, why is this important? It's important because academics are generating prescriptions that are being diffused into practice. I mean, that's the role of talks like this today. That's the role of the Olin Award. And the question is, if you're using a measure that's not reliable, what prescriptions might have been generated that firms adopted? So we took a look at one paper. This was a paper that was analyzing the impact of analyst coverage on innovation. And in the original paper, they believed that analyst coverage would suppress innovation. And they used a patent measure and a citation measure. And they found that analyst coverage decreased innovation. The greater coverage a firm had, the lower the innovation. We replicated their results. We got exactly what they did when we used their measures, but then we tested it again with RQ, and we found there's no correlation between analyst coverage and innovation, which is what we believed inherently. Now, this is just one of the 252,000 academic articles that have used patents from 2000 to 2020. So it seems entirely plausible that this work has contributed to the decline in R&D productivity and economic growth. So my goal was to reverse this decline and revive growth. And so I started by working with companies. I thought, I went to companies, I tried to get them to increase their RQ. And the thought was that would increase their returns. So that would attract investors. They would use RQ to value stocks and would shift investment towards high RQ companies. And as a result, companies would have even more incentive to increase their RQ. And that nice virtuous circle should increase RQ and accordingly increase GDP growth. The problem is that isn't really happening. RQ wasn't getting traction. One of the reasons is investors. So I was working with one CTO. I said, look, your RQ is great. Your problem is that you're underinvesting in R&D. He said, well, there's no way we could increase our R&D. Our investor would kill us. And I said, why would investors kill you for something that's in your best interest? And he just shrugged his shoulders. So then I took it upon myself to educate investors so that firms would have discretion. So I was fortunate there was an RQ 50 platform on CNBC. I gave a master class at the CFA Institute. I was the foreigner there as a strategy professor. I even passed the Series 65 exam. So I was very proud of myself. I went to I gave a talk for a group of CTOs and I said, look, I think I've solved the investor problem for you. You now should have the discretion to do the things that you know are the right things to do. And one of them came up to me during the break and said, I just called investor relations and asked them if anybody was asking about our RQ, and they said no, so I don't need to worry about it. That was so disheartening. But it made me realize that investors may not be the problem. Investors may actually be the solution. So I doubled down on efforts with the investment community. I was fortunate that FCLT Global has adopted RQ as an important measure of long-term value creation. So for those of you who don't know FCLT, it stands for Focusing Capital on the Long Term. This is a group that was co-founded by BlackRock, Dow, McKinsey, Tata & Sons, and the Canadian Pension Board. And as the name implies, they're interested in getting both investors and firms to be more long-term oriented. They did some research that found that RQ was the second most significant factor in predicting our long-term value. They ranked it after capital, and they're not researchers in the academic sense, so I suspect the reason that RQ is behind capital is that they didn't take into account the ordering of things, because there's no need to invest in capital if you haven't produced, if you're not producing the innovations that require the additional capital. So that was one. Done some podcasts. One of them is Behind the Markets on Wharton Radio. And unbeknownst to me, I saw an article by Barron's last fall, actually last summer, and I discovered that Bank of America was using RQ as part of their strategy to invest in companies who invest well. And then they were relying on a measure that the NYSE, the New York Stock Exchange, developed called the R&D Innovation Index, which is based on RQ, that makes no reference to me whatsoever. Anyway, that was my doubling down. I've seen some that was the visible progress rather. What might be more interesting to you is what I see as invisible progress. And what triggered this is that I saw that Nelson Peltz went after DuPont rather than Dow, which is interesting if you understand the RQ differences. So I said, is this happening at a wider scale? And what I found was that the probability of an activist campaign increases in the amount of R&D overinvestment. So they were actually detecting that, and it was decreasing in the RQ. So they were detecting that. So in short, they were targeting firms that were ripe for improvement, which is exactly who they should be targeting. The question is, what's the impact of this? So R&D decreases. It's not a surprise. These companies were overinvesting. Patents increase, which seems like a surprise. It suggests that the firms are innovating more, but I think what's happening is that they're just filing patents for more innovations than they ordinarily would. And then what's happening is they're selling those patents rather than deploying them. And as a consequence, RQ decreases after a few years. In short, activists are liquidating companies' innovation, which is something we should be scared about. So my goal is to get companies to increase their RQ so they won't be targets, so that their capability won't be liquidated. So you can actually help me in my fight, and in the process, you'll be helping the economy and yourself, I believe. One thing you can do is call investor relations for the stocks that you hold and ask about RQ. You can use RQ to evaluate stocks, or you can invest in the RQ50. You can do all three, of course. What is the RQ50? It's the top 50 firms each year, each of whom is based in the US and has $100 million of R&D spending. So just taking the top 50 of those of the set of all publicly traded companies doing R&D. I constructed a portfolio of those firms going back a number of years. Here's the returns starting in 1981. So let's take $1,000 in July 81, let it ride till the end of 2018. We're going to look first at what I call the low RQ50. This is the bottom 50 firms on this measure. Your $1,000 at the end of that period would be worth $17,000. If you take the same $1,000 and invest in the S&P 500, it would be worth almost triple that, $42,000. Now, if instead you invest in the high RQ50, the $1,000 would be worth almost double the market, so $76,000. So what you recognize maybe is that it looks like the benefits from the RQ50 are tapering off, and you might be right. And you also see that it ends in 2018. Now, I presented this chart right around that time, 2018, and I'd been frustrated that I couldn't put my money where my mouth was. And then Tu Luscri, who runs the Scandalera Center, said, hey, you can use M1 Finance to create a portfolio, which is what I've done. And starting in November 2018, I put my money in the RQ50 and letting it ride till the end of last month, so roughly 2.5 years, the RQ50 returned 107%, and the S&P 500 returned about half that. So it continues to exhibit some progress. And if you my goal is to convert this portfolio to an ETF. So if you're at all interested in creating an ETF or investing in one, Wisdom Tree is willing to create one for me. Please send me an email so that I can have justification for going forward. So thank you very much for your attention. I greatly appreciate it, and I look forward to your questions.
Thank you, Anne-Marie. So as a really stimulating presentation, and as Anne-Marie says, we now have time for some questions. We can open it up to you you can put your questions in the chat box, and Dorothy and her team will help me address them. I'm going to start asking a question, Anne-Marie. Is you showed the returns there, but is there anything about the volatility of your high RQ firms as well, right? Because investors think about Sharpe ratios, right? Because you can always increase return by doubling the bet, right? What about the variance or the volatility?
It has the same beta as the S&P 500.
Okay.
Dick Mahoney, can I ask a question?
Of course.
Is this procedure robust, as we say in academia, to research that pays off in, say, 10 or 12 years? Does the measurement still hold up, or is it more for short-term research?
No,
I'm thinking about pharmaceutical, for example, things like that, long-term stuff.
Yeah, yes, it's not inherently a short-term measure. So it takes 7 years of, in order to form one RQ, you have to have 7 years of firm data. So it's taking into account their entire portfolio over that period. So for the pharmaceutical companies, which was your primary interest, the decline in RQ, the decline that I show in RQ matches the decline in productivity that on the measures that they use.
Okay, further questions for Anne-Marie?
I would have behaved well and used the digital hand, but since I'm a co-host, for some reason, I can't actually raise the digital hand. So Dean Taylor stole my question. Yeah, I want to broaden that a little bit from what are the, kind of overall characteristics of the firms that are in that RQ50? Obviously, data is going to be one measure. I'd like to look at that, but that's outside of this presentation. We'll chat robustness there with Dick, you and I later on that one. But what kind of, what do you see sort of maybe just qualitatively in those RQ50? And how are they kind of balancing their overall resource allocation? I mean, obviously you're investing for what's next, but you're also investing to keep the lights on, execute what's already the fruits of that. So kind of thinking, how do you balance all those pieces? I'm going to give you two questions, give you some time.
And you may have to remind me of the second one, but I don't have data on how they allocate their R&D for the most part. I did as part of, so this work is closer to my first paper, where I tried to take firms' R&D practices and link it to their RQ. And so I'll talk about some of those practices. But one of the interesting things is that there's not a correlation across industry, right? So everybody thinks that RQ is picking up industry differences. It's not. The average RQ the average RQ for each industry varies little across industries, all of the variances within an industry. Some interesting things that I found are that the founder RQs are exceptionally high and they roll off as soon as the founder starts to leave. So there's something about knowing why you're doing R&D that's important, and that's internalized by founders, less so by professional managers. Related to that, we found that CEOs who are promoted from inside have higher RQ than those hired from outside. I can give you more. Would you like that, or should we open it up for?
We could open it up. That was fantastic.
Okay.
I'll come back around if it's quiet.
All right.
Okay, so I have another question. Actually. So, do you have all the data to be able to construct this? Right. I mean, obviously you do because you constructed it. Or like marketing, for example, advertising investment. I mean, is that stuff available publicly?
Yes. So I use, when I do the academic work, I use CompuStat, and when I do my consulting work, I use FactSet. So the production function is actually bigger than what I showed you. It does include advertising. Yes, it does include advertising in addition to R&D. So the two intangibles in addition to the tangibles. And that, yeah, as I said, the data is publicly available for public firms. So I can't do anything for private firms unless they, work with me and provide their private data.
Can I ask a further question about pharmaceuticals, since was one of my interests? We were spending well over $1 billion a year. And you take a company like Pfizer was spending $8 billion and getting nothing except what they bought when they bought firms. They bought Lipitor and they lucked into Viagra and they bought our product. And so they had outcomes, but there were outcomes from spending $80 billion to buy a company. Their R&D was essentially unproductive, except for reinforcing old products. Does your system pick up that sort of thing?
Absolutely. Their productivity has declined dramatically, and at the same time, they're over-investing in R&D. So if you continue to use the same rules of thumb for investing, what will happen is your RQ will be mechanically less productive. But not only did they not, but they didn't just maintain their rules of thumb, meaning R&D as a percentage of R&D, they actually increased it dramatically from, I think it was 4% to 12%. And they were already overspending, and the industry got rocked, right? By lots of things.
Yeah.
So in your JFQA, your Journal of Financial Quantitative Analysis article, right? What are the key financial takeaways for a finance industrial?
Well, if you want to invest in, firms who do R&D, you ought to be paying attention to their RQ rather than their patent rates.
Right. And you showed those figures where you have the low RQ, or even below the market, right? Then the high RQ are above the market.
Yeah.
So presumably you could have a long short strategy, right? You go short you wouldn't have to have any money, right? Just go short of the low RQ.
So I would love to work with you, Dean Taylor, on that. Maybe you and I can create the ETF.
Counts as experiential learning. Get a student team behind it to run the numbers, put Olin's capital in there. It's a fantastic idea.
Oh, I would like to get Olin's capital in there. I approached the WIMC and they were not willing to put their money in. So there's
at a risk of sounding unintelligent and and admittedly I am doing a bit of multitasking here. I don't want to re-ask the same question that was already asked, but with regards to organic R&D versus acquiring companies that are heavy in R&D, did you find a distinction there? And I'm just, borrowing from my own experiences at other firms, seeing that, like an organization that had no interest in R&D, but was very acquisitive and was interested in acquiring firms that perhaps did at one point in time. And then what is, in terms of longevity, what did you see over time with those?
That's a great question, and I didn't cover it, so you're off the hook.
Cool.
So I only looked at firms who were already doing R&D. I didn't look at firms who started, who started from no R&D. And what I found is that it matters how big the acquisition is relative to the current size of the firm. So the number that I used was the 3-year, sum up the total market cap of the things you acquired over 3 years at the time that you acquired them and divide that by your own market cap. And the more that increased, the lower your RQ. So there's not a substitute for doing your R&D. On the flip side, however, if you are acquiring firms like we see in the pharmaceutical industry at early stages, and you have better capability to get things out to the market, then that does create value. right? So a nice example is Medicines Company, which had been in the RQ50 for forever, one of my darling companies. They were acquired by, oh, Dick, maybe you know this, 2 years ago, for 2 years ago, and it was great. Because now a dog that had really phenomenal potential was actually going to realize that potential because it was going to get to a broader set of customers.
Where can we find that RQ50 list? I just did a very quick cursory search and I found your Forbes article, but I did not.
Oh, okay.
I've yet to stumble upon.
So if you go to amkanalytics.com, there's a page describing the RQ50 and giving you the list of the current RQ50. Now, this turns over after the fiscal year closes, so the new one will be available around July.
Fantastic.
Maybe put that in the chat before we close up, Anne-Marie.
Oh, sure. That's a great idea.
Thank you.
Thank you.
Any further questions for Anne-Marie? So where is your research going on this next, Anne-Marie? Is this the final word?
Oh, no. Well, one of the things that comes to the top of my mind is people have said that one of the reasons productivity has declined is because companies have closed their corporate research labs. People fall in love with their corporate research labs. And I believe that too. We went back, there's directories of corporate research lab going back to the 1921. So we had the set of all those firms. And our preliminary results indicate that basically no effect. So there doesn't appear to be any benefit from having a corporate research lab. So we're spending our time trying to understand why that would be true. And I'm also trying to work with policymakers. So
you started this discussion to talk about the Roma model of endogenous growth, right?
Yep.
The missing factor in traditional production functions is knowledge, basically, and have you done any work, kind of thought about doing any work at that macro level, right? You have macroeconomists actually.
Yes. So thank you for asking that question, because this is my favorite paper. So the economists who discovered the same productivity decline, but at the economy level, think that the problem is we've exhausted technological opportunity. So they just say R&D is getting harder. But they actually never test that. They have an empirical paper where they basically show that R&D productivity is declining everywhere they look. But of course, that's the motivating observation. We actually test the theory that generates that proposition that R&D is getting harder, and it's not getting harder, which is really encouraging, because if they're right, we might as well all go home. If I'm right that firms are getting worse at R&D, there's things that we can do to fix it. And kind of a neat example is that I tested not what was happening to average RQ, but what was happening to the maximum RQ each year. And it turns out maximum RQ is actually increasing over time. So we're actually increasing more technological opportunity. But if you narrow down and look at sector level, that still seems to hold. But if we narrow down and get to industry level, it's declining within industry. So what that seems to suggest is that as opportunity declines within industries, firms are creating new industries with even more opportunity. And if you think about our, some classic examples, this would not be a surprise to anyone. So you think about typewriters being replaced by personal computers. There are only about 10 million electric typewriters in the US at the peak. There's over 300 million personal computers in the US. Currently.
You say, but has this gone in? Have macroeconomists picked up on this yet, or is there a paper to be written there as well?
So that paper that I just described, saying that R&D is getting harder, was published in AER. This is where I get to vent. maybe the broader audience isn't interested in that. And so I wrote a comment paper. We wrote a comment paper and showed that they actually never tested their title. And we showed that when you do test their title, that it's incorrect. And they said, well, on its own, that's not enough to justify an article.
Right.
Which is really incredible.
Anne-Marie, I've got a little software company, $10 million. We spend $800,000 on R&D. I've always believed that R&D is a crapshoot, and the more bets you put on the table, the better your chances. And I love it when people declare defeat and go on and will give us more money to try something else, because that lets another opportunity go on the table. I've been watching this little company, and the results come in bursts. And I wonder how sensitive your work is to these bursts, because, for example, the technology changes and cloud techniques come in, and things change, and nothing is dead for about 4 or 5 years. Then all of a sudden, bam, we lucked into having the research ready when the market came together. And so the results are phenomenal. And then we put another bunch of R&D in there and nothing happens. And 5 years later, another set of circumstances come together. Is your technique responsive to these really long lags, or is it more smooth results?
So the real answer is that if that's truly what's happening and you don't have a portfolio that pools more of those projects together, RQ is going to be a very poor measure. So it works best when when the ratio of projects at various stages is fairly stable.
So you're looking at a pipeline that has a assembly line where the products are coming
Yes.
off on some regular basis.
Yes.
And then
Yes,
it's just not true in this company I've got.
Right.
It was
right.
more true in the pharmaceutical business. This is a
Right.
data storage company.
Yeah. So early stage companies, it's not going to be a good measure because they're basically just bets, right? And you have to characterize them that way. They're projects, so we should use project level analysis
Well,
rather than
a well-run pharmaceutical company, as you well know, has a pipeline. They've got to keep their marketing filled up and their manufacturing and their patents and all that stuff, and the FDA. So if they're running a little dry, they have a outside firm go out and find some new products to throw in the pipeline.
Mm-hmm.
And I guess they show up as successes in your analysis because they're dropping off. They have to drop off a product every now and then.
Yes. Now, if you're buying
by licensing or whatever other technique they have to use.
So if those companies have not commercialized their product yet, that will show up as R&D, and so it captures that acquisition very nicely. Just putting them out at the back end and increasing revenues without changing R&D will not show up as a high RQ.
But if they license in a bunch of products to fill in the pipeline, does that show up as a gain?
Licensing will not show up in R&D, but once they license them in, they do have to do R&D. Yes, so licensed in things, the R&D for things that you're licensing in, if you've done a really good job of selecting what to license in, will show up as higher RQ, yes.
Because that's an essential part of running a proper pipeline and having stuff coming off on a regular basis. Because you can't run dry for 5 years in a row. You'll destroy the marketing and the FDA and everybody else.
Absolutely. Yep.
I have one final question. So, sorry, Dorothy. A quick question about the new normal, right? Do you expect the quotient, the research quotient, to be affected by as we come out of the pandemic?
Yes, because I saw there was a dip during the last financial crisis. So but it'll be a short-term dip.
Okay, so Dorothy.
So there's one question in the chat, Anne Marie, about Bill Weeks asked, can we get RQ data in fact?
I would love, if you could do that, I would love that. My big goal is to get RQ to diffuse. So if anybody can tell me how to get it into FactSet, into Bloomberg terminal, into the Icon terminals, I would love you. So far, no. But yes, the more it's out there, the more people are going to pay attention to it and the more firms will try to improve it. So I would love that. Thank you, Bill.
Okay, well, perhaps we should be winding up. We've got like 1 minute left, but Anne-Marie, congratulations, right? So this extremely well deserved for the second time, and you convinced me that was no card trick. Thank you, and thank you, Dick, for your support of the Olin Award over the years and continuing. And thank you all for attending. And please reach out if we can be of assistance or help you in the application of research to your organization. Either contact Anne-Marie directly in this case, or Dorothy or myself. So thank you so much, and I'll see you again next time.
Thank you.
Congratulations.
Thank you, Dick. Thank you for for the sponsoring the award. Yeah.